For generations, we have been told a comforting lie. Work hard, save your money, avoid debt like the plague. If you want a comfortable life, cut up your credit cards and pay in cash. But while the modern middle class spends their entire lives stressing over bills and trying to scrape together enough money to clear their balances, the truly wealthy are operating under a completely different set of financial rules. They look at the exact same financial system and see an entirely different landscape. To the average worker, debt is a heavy shackle. It is a slow, crushing weight that anchors you to a desk for 40 years, forcing you to trade your precious time for depreciating paper currencies. But to the top 1%, debt is not a liability. It is a weapon. It is the ultimate wealth acceleration engine. It is the closest thing to real-world magic, allowing them to buy massive companies, accumulate thousands of rental properties, and legally bypass the tax code without ever spending a single dollar of their own money. How can something that ruins millions of ordinary families be the exact foundation of generational wealth? The truth is deeply uncomfortable. The economic system is intentionally designed to punish savers and reward borrowers. While you are working 40, 50, or 60 hours a week just to keep up with inflation, the ultra-wealthy are using other people's money to build empires. They have figured out how to make the banks work for them, transforming liability into leverage. If you ever want to break free from the traditional rat race, you have to stop looking at money through the lens of fear. You need to understand the dark psychology of leverage and master the precise strategies the global elite use to multiply their fortunes. If you want to uncover the hidden mechanisms of the financial system and take control of your economic future, hit the subscribe button right now. By joining this community, you will gain access to regular, high-impact breakdowns of wealth psychology and financial strategies that school never taught you. Let us build this base of knowledge together. Think about the global economy for a second. It is entirely driven by credit. Every dollar in circulation is technically backed by a debt obligation. When you realize that money itself is debt, you start to understand why the rules are rigged against those who try to save it. Robert Kiyosaki famously stated that the rich use debt as money, while the poor and middle class use debt to buy things that make the rich richer. This distinction is the core boundary line between financial freedom and lifetime economic captivity. When an ordinary person borrows money, they typically do it to buy a depreciating consumer object, like a brand new car, a bigger television, or a luxury vacation. The moment they swipe that card or sign that loan agreement, they have committed their future labor to pay for a past luxury. They are trading tomorrow's time for today's illusion of wealth. But the rich do the exact opposite. They only borrow money to acquire cash-flowing assets that pay off the loan for them. The first major way the wealthy exploit this system is through the classic real estate arbitrage strategy. Imagine purchasing a $2 million apartment complex. An ordinary investor might think you need $2 million in cold hard cash to buy it, but the wealthy individual understands leverage. They put down a 20% deposit, which is $400,000, and borrow the remaining $1.6 million from a bank. Let us say the interest rate on that mortgage is 6%, which means their annual debt payment is roughly $96,000. If that property generates $200,000 a year in rental income from tenants, the numbers completely flip. The tenants pay the $96,000 mortgage, cover the maintenance costs, and leave the investor with a clean profit of tens of thousands of dollars. The wealthy individual did not use their own cash to buy the building. They used the bank's capital, and they're using the tenant's labor to clear the balance. Over 20 years, the property value doubles due to inflation, the debt gets wiped out by the renters, and the investor ends up owning a multi-million-dollar asset for a fraction of its original cost. That's not just investing, that's using debt to force the world to build your wealth for you. But it goes much deeper than simple rental properties. The second mechanism is the highly sophisticated strategy known as the buy, borrow, die framework. This is the ultimate playground of the ultra-wealthy, and it explains why the richest people on Earth often pay a lower effective tax rate than a middle-class school teacher or a corporate manager. Let us look at the math. If you earn a salary of $200,000 a year at a high-end corporate job, you're hit with heady income taxes, often losing 30 to 40% of your paycheck before it even hits your bank account. You cannot outrun it. But if a tech billionaire owns $10 billion worth of stock in their own company, they face a unique dilemma. If they sell those shares to buy a superyacht or a luxury mansion, they trigger a massive capital gains tax event. The government steps in and demands hundreds of millions of dollars. So what do? They do not sell a single share. Instead, they walk into a private bank and set up a securities-backed line of credit. They pledge their $10 billion stock portfolio as collateral to borrow $500 million in cash at a minimal interest rate, say 4%. Now, here is the psychological kicker. The IRS does not consider borrowed money as income. Debt is not taxable. The billionaire receives $500 million in tax-free cash to live an ultra-luxury lifestyle. Meanwhile, their underlying stock portfolio continues to grow at an average rate of 8 to 10% per year, easily outpacing the 4% interest on the loan. They never pay off the loan during their lifetime. When they eventually pass away, their estate sells a portion of the stepped-up assets to clear the bank debt, entirely bypassing decades of income and capital gains taxes. As Morgan Housel wisely noted in his writings on wealth psychology, doing well with money has a little to do with how smart you are, and a lot to do with how you behave. The wealthy do not behave like earners. They behave like asset owners who use debt as a shield against the state. The third way the elite weaponize debt is through corporate leveraged buyouts. This is how massive private equity firms acquire huge brands without risking their own capital. Think of it like buying a car, but making the car itself pay for the auto loan. When a group of wealthy investors decides to buy a $100 million manufacturing company, they do not write a check for the full amount. Instead, they structure the deal so that 70 or 80% of the purchase price is funded through high-yield debt. The brilliant yet terrifying twist is that this massive debt is not placed on the investor's personal balance sheet. It is legally transferred directly onto the balance sheet of the company they are purchasing. Once the acquisition is complete, the company must use its own operational revenues and profits to pay off the massive loan that was used to buy it. If the company succeeds, the investors make astronomical returns on a tiny initial investment. If the company fails under the weight of the debt and goes bankrupt, the investor's personal wealth is completely protected behind walls of corporate liability. They take all the upside while outsourcing the downside risk to the financial markets. Then comes the quiet thief that destroys the middle class but supercharges the wealthy: inflation devaluation. This is the fourth strategy. Most people view inflation as a catastrophic penalty, watching their grocery bills soar and the purchasing power of their savings evaporate. But if you hold millions of dollars in fixed-rate, long-term debt backed by real assets, inflation becomes your best friend. Imagine borrowing $5 million in 2026 to buy commercial real estate at a fixed interest rate. Over the next 10 years, the central bank prints more currency, causing the value of the dollar to drop significantly. Because there are more dollars floating around the economy, prices rise, and the nominal cash flow from your real estate increases. Your rents go up, your asset value goes up, but your $5 million debt to the bank stays exactly the same. You are paying back a fixed historical loan with inflated, cheaper dollars. Inflation literally melts away the real value of your debt while expanding the nominal value of your assets. The saver loses 20% of their purchasing power, while the wealthy debtor effectively receives a 20% discount on their loan, courtesy of the monetary system.
The fifth method is the tactical use of business tax arbitrage and depreciation write-offs. When a wealthy business owner borrows money to buy heavy machinery, delivery vehicles, or corporate jets, the financial system rewards them with massive tax incentives. Under sections of the tax code like Section 179 or bonus depreciation, businesses can often deduct the entire purchase price of qualifying equipment from their taxable income in the very first year. If a company generates $1 million in taxable profit, the owner can take out a low-interest bank loan to buy a $700,000 piece of specialized machinery. They did not spend their own cash, they used the bank's capital. Yet the tax code allows them to write off that entire $700,000 against their business revenue, dropping their taxable income down to $300,000. They save hundreds of thousands of dollars in taxes, preserve their liquid cash, and add a productive, revenue-generating asset to their business using money that technically belonged to someone else.
Finally, the sixth strategy is private equity scaling and venture debt. In the modern startup ecosystem, founders and elite investors do not want to dilute their ownership by selling equity to venture capitalists too early. Instead, they use venture debt to fund massive expansion phases. They borrow millions of dollars against their future enterprise value or recurring subscription revenues to hire top talent, scale marketing campaigns, and dominate markets. By using debt instead of selling stock, the founders maintain total control and maximum equity ownership. When the company eventually goes public or gets acquired at a multi-billion-dollar valuation, that initial debt looks like a microscopic footnote, while the equity they preserved makes them staggeringly wealthy. When you step back and look at these six strategies as a cohesive whole, you realize that the financial matrix is real. The system is not broken, it is doing exactly what it was designed to do. It is a massive siphon that transfers purchasing power away from those who trade their time for cash and hands it directly to those who use credit to accumulate assets. Ray Dalio frequently emphasizes that if you do not understand how the economic machine works, you will inevitably become a casualty of it. For the average person, breaking out of this cycle is incredibly difficult because the psychological programming runs so deep. We are conditioned from childhood to fear debt, to view it as a personal moral failure, and to seek the safety of a steady paycheck. But true financial freedom requires a complete cognitive rewiring. It requires you to shift your identity from a consumer to an investor, from a saver to a master of leverage. The next time you look at a bank, do not see it as a vault to store your hard-earned cash. See it for what it truly is, a leverage warehouse, waiting for someone with the courage and intelligence to use its resources properly. Stop working for money and start structuring assets that force money to work for you. If this breakdown opened your eyes, leave a comment below with your thoughts on how you view debt. Share this video with someone who needs to see the matrix. And don't forget to like and subscribe for more deep dives into the hidden realities of wealth. The machine is running 24 hours a day. The only question left is whether you will continue to feed it with your time or finally learn to command its levers.